The ongoing conflict between Russia and Ukraine, which escalated with Russia's invasion in 2022, has significantly impacted global finance, sending shockwaves through markets and economies worldwide. One of the immediate effects was the dramatic increase in energy prices, as Russia is a major exporter of oil and natural gas. European countries, which relied heavily on Russian energy supplies, faced an energy crisis as they sought alternative sources, driving prices even higher. This increase in energy costs has contributed to inflationary pressures globally, particularly in Europe, where households and industries have struggled with soaring energy bills.
Firstly, thank you for watching, and don't forget to smash that like, subscribe, and notification bell for more global finance uncovered, as we continue to work hard and around the clock to always deliver and improve on our content for you. We would greatly appreciate your additional support by you clicking the like button, notification bell, and subscribe button and joining our channel's growth.
Sanctions imposed on Russia by Western nations have further complicated the global financial landscape. These sanctions have targeted key sectors of the Russian economy, including its financial institutions, energy companies, and individuals linked to the Kremlin. The exclusion of Russian banks from the SWIFT payment system severely hampered their ability to conduct international transactions, leading to a significant devaluation of the Russian ruble and destabilizing Russia's financial markets. This financial isolation has forced Russia to turn to alternative systems, such as increasing its reliance on Chinese financial networks and cryptocurrencies, although with limited success. The war has also disrupted global supply chains, particularly in the agricultural sector. Ukraine, often referred to as the breadbasket of Europe, is a major exporter of wheat, corn, and sunflower oil. The conflict has led to the closure of ports and the destruction of infrastructure, severely hampering the export of these vital commodities. This disruption has resulted in food shortages and price increases, particularly in developing countries that are heavily reliant on Ukrainian grain. The resulting food insecurity has sparked concerns of political instability in vulnerable regions, particularly in parts of Africa and the Middle East. Global investors have reacted to the uncertainty caused by the war with a flight to safety, leading to increased demand for traditionally secure assets like US Treasury bonds and gold. This shift has caused volatility in global stock markets, with significant sell-offs in riskier assets. Emerging markets have been particularly hard hit, as investors have pulled out funds in search of safer investments, leading to currency devaluations and increased borrowing costs for these countries. The war has thus exacerbated financial instability in many emerging economies, compounding the challenges they face due to the ongoing global pandemic.
In Europe, the financial consequences of the war have been severe, with several countries teetering on the brink of recession. The European Central Bank ECB has been forced to navigate a complex environment of rising inflation and slowing economic growth. The need to address inflation by raising interest rates has been tempered by the risk of pushing economies into recession, creating a difficult balancing act for policymakers. The war has also strained the fiscal capacities of European governments, which have had to increase spending on defense and energy subsidies while dealing with reduced economic output. The war has highlighted the vulnerabilities in the global financial system, particularly the risks associated with over-reliance on specific regions or commodities. For instance, the energy crisis in Europe has spurred renewed discussions about the importance of energy independence and the acceleration of the transition to renewable energy sources. However, this transition is costly and will take time, meaning that in the short to medium term, the global economy remains vulnerable to energy price shocks and supply disruptions. The conflict has also led to shifts in global trade patterns, with countries seeking to reduce their economic dependencies on both Russia and, to some extent, China. The war has accelerated efforts by Western countries to reshore or diversify their supply chains, a trend that had already begun due to the trade tensions and the COVID-19 pandemic. This reconfiguration of global trade networks is likely to have long-lasting effects on global finance as countries invest in new trade routes, infrastructure, and partnerships, while businesses face increased costs due to the fragmentation of the global market. The financial sector has had to adapt to the new geopolitical realities, with banks, asset managers, and insurance companies reassessing their exposure to the conflict and adjusting their portfolios accordingly. Many Western financial institutions have divested from Russian assets, leading to significant write-downs and losses. At the same time, there has been increased interest in defense stocks, cybersecurity firms, and companies involved in the energy transition as investors seek to position themselves in sectors expected to benefit from the new geopolitical landscape. The war has also underscored the importance of geopolitical risk assessment in global finance. Investors and businesses are now more attuned to the risks associated with geopolitical instability and are increasingly factoring these considerations into their decision-making processes. This heightened awareness is likely to lead to more cautious investment strategies with a greater emphasis on diversification and risk management. However, it also means that global financial markets may become more sensitive to geopolitical events, leading to increased volatility in the future.
The war between Russia and Ukraine has had profound and far-reaching effects on global finance, from energy crises and inflationary pressures to disrupted supply chains and shifts in global trade patterns. The conflict has introduced a new level of uncertainty and risk into the global economy. As the situation continues to evolve, the long-term impacts on global finance will depend on the resolution of the conflict, the effectiveness of policy responses, and the ability of countries and businesses to adapt to the new geopolitical environment. The ongoing conflict between Russia and Ukraine has also exacerbated existing economic inequalities on a global scale. As the war drives up the prices of essential commodities like food and energy, low-income countries and communities are disproportionately affected. These regions, already struggling with economic instability due to the COVID-19 pandemic, now face even greater challenges in accessing affordable food and energy. This has led to increased poverty and hunger in some of the world's most vulnerable populations, raising concerns about the potential for widespread social unrest. In addition to the immediate economic impacts, the war has had significant long-term implications for global financial stability. The uncertainty and volatility caused by the conflict have led to increased pressure on central banks and financial institutions to maintain stability in the face of growing risks. Central banks, particularly in Europe, have had to carefully balance the need to control inflation with the risk of stifling economic growth. The resulting policy decisions, such as interest rate hikes and quantitative tightening, have further complicated the global financial landscape, leading to fluctuating currency values and increased market volatility. The conflict has also had a profound impact on global trade relations, particularly between Russia and its major trading partners. The imposition of sanctions on Russia has not only affected its economy but has also forced countries to reevaluate their trade relationships. This has led to a reconfiguration of global supply chains, with many countries seeking to reduce their dependence on Russian energy and raw materials. As a result, new trade alliances are being formed and existing ones are being strengthened, with countries like China and India playing increasingly prominent roles in the global trade landscape.
Another significant consequence of the war has been the increased focus on national security and defense spending. Many countries, particularly in Europe, have ramped up their defense budgets in response to the perceived threat posed by Russia. This shift in spending priorities has implications for global finance, as resources are diverted away from other areas, such as social programs and infrastructure development. The increased demand for military hardware and technology has also created opportunities for defense contractors and related industries, leading to a surge in defense-related investments. The war has also intensified discussions around the future of energy security and the transition to renewable energy. As countries grapple with the fallout from the energy crisis triggered by the conflict, there is a growing recognition of the need to diversify energy sources and reduce reliance on fossil fuels. This has led to increased investment in renewable energy technologies such as wind, solar, and hydrogen, as well as greater emphasis on energy efficiency and conservation measures. However, the transition to a low-carbon economy presents significant financial challenges, particularly for developing countries that lack the necessary infrastructure and resources. In the financial markets, the war has led to a repricing of risk, with investors becoming more cautious about exposure to geopolitical uncertainties. This has resulted in a shift away from riskier assets, such as equities and emerging market bonds, towards safer havens like government bonds and gold. The increased demand for these safe haven assets has driven up their prices, while the sell-off in riskier assets has led to significant losses in stock markets around the world. This rate pricing of risk is likely to have long-term implications for global investment strategies as investors seek to mitigate the potential impact of future geopolitical shocks. The conflict has also highlighted the importance of international cooperation in addressing global financial challenges. While the war has strained relations between Russia and the West, it has also underscored the need for coordinated action to manage the economic fallout. Multilateral institutions like the International Monetary Fund (IMF) and the World Bank have played a crucial role in providing financial support to countries affected by the conflict, helping to stabilize their economies and prevent a deeper global recession. However, the effectiveness of these efforts has been limited by the scale and complexity of the challenges posed by the war.
The impact of the war on global finance has also been felt in the currency markets, where the conflict has led to significant fluctuations in exchange rates. The Russian ruble initially plummeted following the imposition of sanctions, only to recover somewhat as Russia implemented capital controls and other measures to stabilize its currency. Meanwhile, the euro has faced downward pressure due to the economic impact of the energy crisis, while the US dollar has strengthened as investors flock to its perceived safety. These currency fluctuations have added another layer of complexity to the global financial landscape, making it more difficult for businesses and investors to navigate the volatile environment. The war has also had a profound impact on the global labor market, particularly in Europe. The influx of Ukrainian refugees has created both challenges and opportunities for the countries that have taken them in. While the arrival of refugees has placed additional strain on public services and infrastructure, it has also provided a boost to labor markets, particularly in sectors facing labor shortages. The integration of refugees into the workforce has become a key priority for many European governments, with significant implications for both social policy and economic growth. Finally, the conflict has led to a reassessment of the role of technology in global finance. The war has demonstrated the potential for technology to both mitigate and exacerbate the impact of geopolitical events. On the one hand, digital platforms and fintech solutions have provided new avenues for cross-border payments and financial transactions, helping to maintain economic activity despite the disruption caused by the conflict. On the other hand, the war has also highlighted the vulnerability of financial systems to cyber attacks and other forms of digital disruption. As a result, there is likely to be increased investment in cybersecurity and digital resilience in the years ahead as governments and businesses seek to protect themselves from the growing threat of cyber warfare.
Thank you for watching, and don't forget to smash that subscribe, like, and notification bell for more global finance uncovered.